Welcome to The Explainer. Today we're going to tackle a huge topic in finance, how to actually value a bond. My goal here is to give you a simple, repeatable workflow that completely demystifies where a bond's price comes from. Let's dive right in. So let's kick things off with a question that honestly confuses a lot of people. You have a bond with, say, a 5% coupon rate. That rate is set in stone, right? It's fixed. So why on earth is it that when you look up that bond's price on the market, it's always moving around? And here's the answer. It's actually really elegant. A bond's price has nothing to do with what it paid in the past. It's all about the promise of what it will pay in the future. And the value of that future money, well, that changes every single day based on what's happening in the market. That's the big idea we're going to unpack right now. To turn that idea into something you can actually use, we're going to walk through a structured 3-step workflow. Seriously, once you get this down, you can value pretty much any standard bond out there. So here are our 3 steps. First, we're going to figure out exactly what cash the bond is going to pay out and when. Second, and this is the critical part, we'll find the correct interest rate to use. Then, third, we just do the math and figure out what all that future money is worth today. All right, step 1, mapping the cash flows. This is all about laying out a blueprint of every single payment the bondholder is set to receive and, just as important, the timeline for those payments. And to build that map, you just need 3 key pieces of info. First is the par value. Think of this as the big final payment at the end, usually $1,000. Second, you have the coupon payments. Those are your regular, steady interest checks. And finally, the time to maturity, which is just how long until that final par value gets paid back. And this is what it looks like visually. It's really a story of 2 different promises. You've got this stream of identical coupon payments, which in finance we call an annuity, and then bam, right at the end, you get your last coupon plus that big par value repayment. Remember that 2-part structure? It's key. Now for step 2, and I'm telling you, this is where most mistakes happen. We know what the future cash flows are, but to figure out their value today, we have to discount them back to the present. And the interest rate we use to do that, well, it changes everything. This slide gets right to the heart of the confusion. In any bond problem, you'll see 2 different rates. The coupon rate is the simple one. It's fixed, and it just tells you how big the cash payment is. But the market rate, or yield to maturity, that's what investors demand today for a similar investment. This is the rate that moves with the economy, and it's the one we have to use for our calculation. Here's the absolute best way to remember this. The coupon rate tells you how much cash you get, but the market rate tells you how much that cash is worth today. That's why you never, ever use a bond's own coupon rate to discount its cash flows. You always use the current market rate. Okay, so we've mapped our cash flows, we've found the correct market discount rate. Now we get to do the final step, the calculation. We're going to pull all those future payments back to today to find their true value. The formula is just a reflection of that timeline we saw. You take the present value of that whole stream of coupons, the annuity part, and you add it to the present value of that big final par value payment, the lump sum part. Add those 2 pieces together, and that's your bond's price. It's that simple. Okay, so that 3-step process is perfect for bonds that pay interest once a year. But let's get real for a second. Most bonds out there in the real world, corporate bonds, government bonds, they actually pay interest twice a year. And that means we need to make a small but really important adjustment. So what do you do if a bond pays its coupon every 6 months? You can't use annual numbers in your math. It just won't work. Everything in your calculation has to be on the same page. So we have to start thinking in terms of 6-month periods instead of full years. This table lays out the adjustments perfectly. If you have a 10-year bond, your number of periods, N, isn't 10 anymore, it's 20. Your annual coupon payment gets cut in half because you're getting half of it every 6 months. And, this is the one people forget, your annual market rate also gets cut in half to find the correct 6-month discount rate. You have to adjust all 3. And now we're at the finish line. We followed the steps, we did our adjustments, we calculated a price, but just getting a number isn't enough. We have to know what that number is actually telling us about the bond. The most important comparison you can make is between the price you just calculated and the bond's par value, which is usually that $1,000. Is your bond worth more than its face value? Is it worth less? Or is it worth exactly the same? The answer tells you everything. And this brings it all full circle, right back to that relationship between the two rates. Look, if your bond pays a coupon that's higher than what new bonds are offering, the market rate, then your bond is a great deal and people will pay more for it, a premium. But if its coupon is lower than the market rate, it's less attractive, so its price has to fall to a discount to make it a fair deal. Okay, for anyone out there studying for a finance exam, a certification like the CFA, listen very, very closely. These next 3 points are the non-negotiable, must-know rules that will guarantee you get these questions right. Rule number 1. This is the golden rule. The coupon rate is only there to calculate the cash payment. The market rate is what determines the price. You must always, without exception, use the market rate, the yield to maturity, as your discount rate, period. Rule number 2. Do not forget the par value. It's so easy to just focus on that string of coupons and completely forget about the big $1,000 repayment at the end. A bond's value is the sum of the present value of both of those cash flows. And finally, rule number 3. This is your logic check. Before you circle your final answer, just stop and look at the rates. If the market demands a higher rate than the coupon is paying, your final price has to be less than par. If it's not, you've made a math error somewhere. This simple check will save you every single time. So now, you can confidently take the inputs and calculate the value of a bond. But that brings up an even more interesting question, doesn't it? This whole process relies on knowing the market rate. So what do you do for a bond that doesn't trade very often, where you can't just look up its yield? Well, that's a much deeper question, and a topic for another day.